Okay, let's look under the hood of a company that honestly operates completely in the background of our infrastructure, but is quietly transformed into a literal billion-dollar growth engine. We're talking about Hawkins Inc. If you love a consistent industrial growth story, let's break down exactly how they pulled off their recent monumental milestones in this explainer.
So check out this massive top-line milestone. In fiscal 2026, Hawkins officially crossed the $1.08 billion mark in sales. That's an 11% jump. They essentially added nearly $110 million in fresh revenue from the year before. Hitting that 10-figure mark, it's a huge psychological and fundamental barrier for any business, right? It just proves their model operates effectively at a truly massive scale. And the philosophy behind that scale? It comes straight from CEO Patrick H. Hawkins. He credits this phenomenal growth directly to the deep trust of their customers and really their critical position within the supply chain. In their latest ESG report, he made it clear, relationships are literally at the heart of everything they do. They don't just see themselves as a vendor, they're an indispensable partner keeping vital systems up and running.
To really understand this success, we're going to unpack it across 4 key areas: essential operations and sustainability, their strategic M&A growth engine, financial health and valuation, and finally, rewarding the shareholders.
All right, kicking things off with Section 1, Essential Operations and Sustainability. To get a sense of their physical reality, just think about their substantial infrastructure in water treatment. This segment alone now makes up 50% of their total company revenue. And even crazier, a massive 56% of their operating income. We are talking about critical chemical distribution and water purification facilities, stuff that local municipalities and heavy industries absolutely rely on day in and day out. To actually deliver all these critical products, they really strive to manage their supply chain with incredible efficiency. They rely on heavy-duty, robust physical transportation networks. Think massive river barges and highly specialized rail cars. Moving hazardous and essential chemicals isn't easy. It requires a logistics network that is, frankly, incredibly difficult for any new competitor to just replicate overnight. But here's the thing, they aren't just moving materials blindly. They're heavily focused on securing their future workforce and minimizing environmental risks. Actually, less than 0.6% of their revenue is tied to highly concerning substances. Combine that with continuous energy efficiency upgrades, plus major investments in local apprenticeships and grants for rural water systems, they are pouring money right back into the communities that keep their business flowing. Moving right along to Section 2, Strategic M&A Growth Engine. Get this, over just the last 5 years, Hawkins has completed a staggering 17 acquisitions. 17. That actually includes 6 transactions closed in fiscal 2026 alone, like their recent purchase of Water Surplus. They are using these deals very deliberately. The goal is to accelerate growth and build a completely end-to-end product portfolio for their core water treatment customers. We're talking chemicals, media, filtration, the whole equipment package. Now, with all these acquisitions, you'll start seeing financial terms like earn-out liability popping up in their filings. If you're not familiar, this is essentially just a performance bonus. It's a future payment Hawkins agrees to make, but only if the purchased business actually hits specific performance targets. It's kind of like getting a bonus payout on a used car if it hits a certain mileage without breaking down. It's a super smart structure because it shifts the operational risk completely away from Hawkins if the acquired company happens to underperform. And as they fold all these new companies in, they are laser-focused on their return on equity, or ROE. Basically, this metric shows how effectively a company uses shareholders' money to generate profit. By tracking the exact profit earned for each dollar invested, Hawkins ensures the capital they're dumping into this aggressive M&A strategy is actually generating real value, rather than just artificially inflating their top-line revenue. You'd think with all this rapid M&A growth, they'd be swimming in debt, right? Well, despite the spending spree, their leverage ratio sits at a highly manageable 1.37 times their adjusted EBITDA. Think of it like a homeowner managing a very reasonable mortgage. It means they aren't dangerously over-leveraging the whole company just to buy growth. They are expanding aggressively, for sure, but maintaining a really solid safety net. Okay, let's dive into Section 3, Financial Health and Valuation. Looking at the numbers to see this financial engine at work, gross profit actually expanded by 9%. Now, net income did see a tiny dip down to $81.5 million, but don't let that fool you. That was totally driven by $16.5 million in acquisition-related costs, like amortization and earnout adjustments.
The real showstopper here is operating cash flow. It's surged an impressive 30% to over $144 million.
When we look at their valuation, the market is absolutely pricing in expectations for continued growth. We're seeing a forward PE ratio of roughly 35.88 and a PEG ratio of 2.56. Investors are clearly willing to pay a premium for Hawkins. Why? Because of their defensive, incredibly essential hedge moat in water treatment, combined with just rock-solid execution of that M&A playbook. Furthermore, their Altman Z-score stands at a very healthy 6.41. For a bit of context, this is a classic metric used to predict bankruptcy risk. Anything above a 3 is generally considered safe. So a score over 6, that indicates a highly resilient balance sheet, which offers a ton of peace of mind to investors who might be sweating over macroeconomic downturns. Which brings us to our final part, Section 4, rewarding the shareholders. That robust $144 million in operating cash we just talked about, well, it's allowed Hawkins to maintain a phenomenal streak. They have just marked their 41st consecutive year of paying dividends to their investors. I mean, surviving multiple market crashes, recessions, crazy inflationary periods, all without cutting that dividend, that speaks absolute volumes about the stability of their cash flow. And these dividends aren't just sitting stagnant, they've been steadily growing. Tracking the recent quarters, the payout steps up from 16 cents in early 2024 to 18 cents, and recently jumping up to 19 cents for May 2026. This equates to a solid annual dividend payout of 76 cents per share, providing a really active and growing income stream for owners. We are also seeing massive confidence signals from the people closest to the action. Over the past 6 months, insider James A. Falconbridge executed an open market purchase of nearly $400,000 in stock. On the institutional side, heavyweights like Kane Anderson Rudnick added over 377,000 shares to their portfolio. You combine that with continuous buy ratings from analysts, and it's obvious the smart money is aligning right alongside the company's trajectory. So that leaves us with one final question to chew on. Given their essential, almost utility-like market position, this compounding M&A strategy, and a flawless 41-year dividend record, is this the kind of consistent, sleep-well-at-night growth story that belongs on your radar? Take a close look at your own investment criteria and see if this quiet giant fits the bill. Thanks so much for joining me for this explainer, and I'll catch you next time.